So one of the other aspects of accounting for income taxes on your financial statements is this valuation allowance and determining whether it's needed or not. Okay, so a couple of things that it's important to know is that this valuation allowance is required if it is more likely than not. That is an important phrase to remember, that some or all of the deferred tax asset will not be realized in the future. Okay, so you've got these deferred tax assets, right? And remember, those deferred tax assets arise because sometimes your book income is larger than your taxable income right now, but you have the possibility that that will reverse, right? So these are going to be a result of temporary differences, right? Because those are going to reverse potentially in the future. But the only way that they can reverse in the future is if you have enough taxable income to absorb those other deductions down the road. Okay, so that is why you have to evaluate whether you're actually going to get to use this valuation allowance, or excuse me, these deferred tax assets. So to make this determination, you've got this whole list of items that the company must look at. Okay, and so these are all future and past sources of taxable income. Okay, so you've got these items. Now, another thing that it is important to remember is that a company must evaluate positive and negative evidence. All right, so it's very important that you not just look at positive evidence, but also the negative evidence. Okay, and then it's going to have to every quarter look and see if this valuation allowance gets increased or decreased. All right. And in one of the other videos, there was an example where the tax rate was decreased from 34% down to 21%, like when the Tax Cuts and Jobs Act went into effect. And so all of those deferred tax assets that companies had on their financial statements had to be revalued based on that decrease in the tax rate. So all of those valuation allowances would have been reevaluated at that time. All right, so that's a real world example of what could cause this. Okay, so again, you've got this more likely than not standard, which is a greater than 50% is the number that's attached to that. Okay, now there are 4 sources of potential future taxable income that that ASC 740 identifies, and I'm going to write those down here. So I'm going to move this up. Oops, hold on. That does not say 4. It was meant to. All right, so we get these 4 sources of potential future taxable income. 2 are objective, all right? All right, and those 2 objective sources are future reversals of existing taxable temporary differences. So meaning if you have a taxable difference right now, so right now in the current year, it's an unfavorable temporary difference. As you look for that to reverse, right, that's a potential future source. okay? And then taxable income prior to any carryback years. So those are the two objective sources. And objective means they're clearly measurable, right? You can look at the existing taxable differences and know what portion of that is going to reverse. Whether or not you'll be able to use that is a whole different deal. And then obviously you can look at taxable income in previous years, right? To know kind of what your history is. Not that history is a great predictor of the future, but it certainly can give you some idea. All right, so those are the objective sources. And now there are also two subjective sources. And here's where management comes into play, because these are subjective sources. So management has the ability to kind of, their opinion matters here, and their view on the world matters. Are they a glass half empty or a glass half full kind of manager, CEO? Okay, so these are subjective sources. And so the subjective sources, the first one is expected future taxable income. And when they look at the expected future taxable income, they're looking at that without any reversals, without any reversals of temporary differences or carryovers. So without temporary difference, reversals, or carryovers, okay? And so again, this is a subjective source, source, because this word expected, right? We're asking managers to kind of opine on, do they think taxable income's going up? Do they think taxable income's going down? So this is their kind of opinion, their view on what the future holds. And obviously macroeconomic conditions are going to play a role here. What's inflation doing? What's the tax code doing? Who's controlling Congress? Who's in the presidency? Okay, so that's the first subjective source. I'm going to move up a little bit again. All right, and then the second subjective source are tax planning strategies. All right, and this is very subjective, right? Because some managers are more aggressive than others. And so if you are in my tax research class, we've talked about potentials for audit and those types of things. And so, as you start engaging in different tax planning strategies, your odds of audit from the IRS may go up or down. All right. And that's going to impact your taxable income. You also have to worry about, because we're talking about financial statement pressure here, right? The impact of the SEC and how you're disclosing different tax planning strategies, and how the SEC will look upon those things. So when we talk about this valuation allowance, all right, there are several key things to remember, all right? So you need to remember that, and I'm going to move my slide around again here so I can kind of highlight some things, okay? So you need to remember this more likely than not standard, all right? That's a very important piece, this more likely than not standard, okay? You need to think about all of its sources. And then remember that a company must evaluate positive and negative evidence, and that it's a moving target, right? Because this gets adjusted every quarter, right? And that concludes the nuts and bolts of this valuation allowance.